If there is anything that we learned from this past week action in the stock market, is that most individuals should not be owning stocks. They really shouldn't be owning stocks. And in today's video, I will talk to you about the 10 reasons why most people should not be owning stocks. If you're new to this channel, my name is Mariusz Konieczny and I run Microcap Explosions, a website dedicated for microcap stocks which are hated and ignored by the investment community. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com, so make sure you get yourself a copy. Everybody wants to make money in the stock market because it's so easy to make money. So many people are attracted to this idea, but unfortunately, most people should not be investing in stocks. They don't have what it takes. And so let's go through some of the reasons why I think most investors should not be invested in stocks. Number one, they're simply too emotional. Too emotional about the fluctuations, too emotional about what's happening in the economy. They watch their portfolio constantly. Their emotions drive their investment decisions. When they are happy, they are more likely to buy the stocks. When they are unhappy, they're more likely to sell the stocks. Number two, they don't really know why they own the stock. They might get the idea from somebody on YouTube, read a newspaper, watch something on TV, follow somebody on Twitter. They borrow someone else's idea. They don't understand why they own it. And as a result of this, when the prices move in the opposite direction or go below to what they paid for the prices, they don't have, the belief in the company. They don't know why they own it. And then as a result of this, they become weak hands during the times that they should have strong hands. Number three, they don't have the conviction. And conviction comes from doing the due diligence. This is kind of tied up with point number two. They don't have the conviction because they didn't truly do their own work. They didn't do their due diligence. You can borrow someone else's idea, but you cannot borrow their conviction. The conviction only comes from your own work, from your own reading, from your own due diligence. You can't borrow it. And because most people don't want to do their work, it's either because they don't have time, they're too lazy, or they don't have the capability of doing the work. Because of this, they do not have the conviction to hold the stocks through the turbulent times. Number four, they cannot take the volatility. Public markets are completely different animals than private markets. If you want to buy a private business, the valuations or pricing in private businesses, they don't fluctuate that much from quarter to quarter, from year to year. They are very much tied to the value of the underlying business. And that's because both buyers and sellers are true owners of businesses and they look at fundamentals. In the public markets, you are dealing with non-fundamental owners. They're not even owners. Traders are not owners. Hedge funds are not owners. They should think of themselves as owners, but they don't. And as a result of this, the price fluctuations are tremendous in the public markets. Also, people think that when they buy the stock on Monday, they expect the price to increase on Tuesday or from the moment that they bought it. Yeah, they think they're so special that when they buy this stock at a particular price, the moment they buy it, the stock price should go up. Number five, having a short-term focus. Over the years, the attention span of people shortened tremendously. We live in a world of instant gratification, and this is the same for investing. The investment horizons for most investors got shortened. Everybody is in the 3 inches in front of your face. Barely anybody is able to hold positions for long periods of times. But because they have such a short-term focus, in the short term, the stock market is a voting machine. In the long term, is a weighing machine. So in the short term, the prices can fluctuate a lot and they can create a lot of emotions. But because people have such a short-term focus, they shouldn't be investing in the stock market, because the stock market over long term is a weighing machine. But if they don't have the capacity to wait long periods of time, the stock market is not the best place for them. Number six, they cannot think independently. Most people want to invest in stocks or investments when they have a company. They want to feel cozy and comfortable. They want to have the feeling that their favorite money manager or their favorite investor is invested alongside with them. That leads to overpaying for things and buying investments when they are overhyped by somebody else. That's a recipe for disaster. Thinking independently is one of the most important things that an investor can develop. Number 7, they want to invest in what is popular, and that's kind of tied up to the previous point. When people buy real estate, their house, it's obvious for them that when they are bidding on a property, they don't want to have competition from other buyers because they want to buy their house. And when they are selling the house, they want a lot of people to look at their house so that they can get a good price. In investing, investors do the complete opposite. They want to be invested in popular names. Popular names means a lot of other people are invested in those names. As a consequence of this, if a lot of people are interested in a particular idea, that particular investment is likely to be overpriced, is not likely to be offered on sale. And the best returns are generated when you can buy something for less than what it is worth, which means you have to invest in it when other people are not interested in it and when the idea is not popular, at least not popular yet. The best way is to invest in something when it is not popular yet, hold it, and maybe sell it when it becomes popular and overhyped. Number 8, they take direction from Mr. Market. Mr. Market is a great analogy talked about by Benjamin Graham. Warren Buffett talked about it a lot, how when you are invested in a particular business, you are invested with a partner. Your partner is Mr. Market. And Mr. Market comes and knocks on your door every day and he expresses his interest in buying or selling you an interest that he owns or buying the interest that you own. But the problem with Mr. Market is that Mr. Market is manic depressive. Sometimes he's very happy about things, about the company that you own with him, about the economy surrounding it, and sometimes it's the opposite. So unfortunately, most people shouldn't be investing in the stock market because they take direction from Mr. Market. They listen to the Mr. Market, even though Mr. Market is manic depressive. They get happy with Mr. Market and they get depressed with Mr. Market. So as a result of this, they tend to buy high and sell low because they take direction from Mr. Market. Number 9, they focus on price versus value. You see, in order to make successful investments, you have to have two variables. You have to know what you're paying for something and you have to know what you're getting in something. Price is what you pay, value is what you get. Most investors focus only on price, on the movement of price, and somehow that price dictates to them whether something is a good investment or not. So in other words, if the price goes higher, they think the investment is great because they have the confirmation from everybody else. When the price goes down, they get depressed and they think the investment is bad. Sometimes it's true. A lot of times it's not. Price in the long term will reflect the value of the underlying business. But in the short term, the business could be doing fantastic, but the price might be going in an opposite direction. So if you're only looking at price, you're only looking at one piece of information. You have to have two. You have to have a price and value. And unfortunately, most people don't pay attention to these two pieces of information. Number 10, most people are not subscribed to this YouTube channel, and therefore it's not a very good idea for them to invest in the stock market. In summary, I hope you enjoyed these 10 points. I really truly believe that most people should not be investing in the stock market because they lack the discipline and they lack these 10 points. Now, the good news for us is that because most people are not suitable to be investing in the stock market, they will lose money very quickly. And if you have those 10 points, if you can think independently, if you have the right discipline, the right mindset for investing, you can make a tremendous amount of money simply by exploiting the people who don't have the skills but still want to go and lose money in the stock market. Thank you for watching this video. I hope you enjoyed this content. I would greatly appreciate if you took the time to subscribe to this channel, click on the notification bell, like the video, and comment on the video. I will do my best to reply to every single comment. Thank you for watching.